It sounds broadly, Katie, like you think the momentum in the various asset classes will continue in the direction which they're right now. For equities, I get that. For the dollar index, which just hit a fresh 2-decade high this morning, do you also see that momentum continuing even here? And for yields, do you see the yields continuing higher with the momentum, especially on the 10-year side, where many people say that there's probably a cap in sight to the 10-year yield?
Yeah, I wouldn't disagree with the thought about that, right? But the momentum, as you mentioned, is still there. The momentum is still very much to the upside behind both the dollar index and yields. And checking the individual sort of crosses on the FX side, I mean, the pound just continues lower. There's really, the signs of downside exhaustion that we've seen there have just been completely shrugged off. So it's really a caution to fight these trends. And I think we can assume that at least with no resistance nearby for the dollar index, actually the resistance is well above, it's around 121 for the dollar index. And for 10-year Treasury yields, resistance being around 4%. I think we have to trust that those uptrends will persist. The consolidation phases would be very natural, but yet the market just seems bent on moving higher in those areas.
How do you feel about the largest cap stocks in the S&P 500? Because while we have seen them test June lows, many of them, we've seen them come off their highs. We've seen their multiples compress. We haven't seen them come to market multiple. And I'm wondering if that is in the cards, according to the technicals.
I would worry about that for sure, because you saw off of that August peak some underperformance from the mega cap complex, including Apple. Apple has really been sort of the stalwart performer for the whole equity market. And I think we should reasonably be focused on it. If it were to break down, I think that's going to create a bit of a waterfall effect, in that we'll see underperformance then also transfer to the higher growth names that have actually done relatively well. If you look at the sort of small to mid cap software names, they look so beaten up, and they've actually held up relatively well. But I think that's where you're going to start to see them reach new lows as well. So it's all eyes on Apple, reasonably so. And the support that we're watching there is around 150. We feel like that's a psychologically significant level. It is a support level based on the metrics that we follow. So if that potentially breaking, we would see that as a negative indication for, of course, the major indices.
Katie, if we do fall below the June closing low for the S&P 500, what was that, 36.66? If we fall below that, what are the next levels? What are the next floors?
The support I've been watching for the S&P 500 is already being tested. It's around 38.15. That 36.36 level is obviously widely watched as well. If 38.15 is broken on a consecutive weekly closing basis, so we can trust we'll get one close below today, and if we get it again next Friday, that would be a major breakdown in our work, in that the next targeted support level based on Fibonacci retracements would be around 3,200. And that wouldn't be a near-term objective. It'd be something that's more likely relevant in 2023. But it obviously would increase downside risk for the major indices. So it's that 38.15 level that's key. There is some interim support for the S&P 500 around 3,500. And I wouldn't rule out a test of that level before year end.